All right, so good afternoon, everybody, and I'd like to thank Danny Riley and the folks over at Mr TopStep for the invitation to present today in the boot camp. And this is an exciting opportunity for me to extend what we're doing over here at Polaris Trading Group into the boot camp room over at Mr TopStep. So very, very nice. Thank you, Danny, for the invitation. So. What I'd like to do is, most of you have learned a lot of presentations on some very, very good topics throughout the presenters already this week, and I'm going to just touch upon a topic called the 3-day cycle. Many of you are perhaps familiar with it. It's the tailor trading technique. It has been popularized for a number of years, and some people have kind of moved away from it for some new kind of fancier type trading styles and techniques. But I have found that the tailor trading technique provides me a framework for my trading, and again, I want to present that. There's a number of professionals out there that utilize the tailor technique. I just simply call it the 3-day cycle. There are other types of cycles. 2.5 to 4 days has been presented, and there's other, some people use 5 to 7 days and Hearst cycles and things of that nature. All right, so there's a lot of ways of analyzing the market and getting a technique that fits. I have found that the 3-day cycle works very well in what I do and how I approach the market. So I want to present that now, to everybody. All right. So as we get going here, again, everybody knows the industry regulations about the various disclaimers, NFA Rule Compliance 2-29. What I do want to say, the Polaris Trading Group does offer educational services and products on a subscription basis, and we're not advisors, and so we do offer education and trading, and we do have our own trading room with the membership. So feel free to explore the URL website that has been posted in the room here. A little bit of my background first before we get going. Again, I'm a 30-year trading professional. I have worked for the investment banks and various hedge funds for the past 30 years, and I'm currently an independent day trader, just as many of you are. My background has scanned Shearson Lehman Brothers, United Bank of Switzerland, UBS. I believe Danny and I were actually working at UBS at the same time, though different areas of the firm, and our paths never actually crossed. But I think he was running the program desk at the time. And I've worked for a couple high-frequency trading funds as well. During my days over at the investment banks, I was a market maker in listed and NASDAQ stocks. I've also had quite a bit of experience trading index futures and derivatives, and involved in various aspects of the portfolio risk management. So that is a little bit of my background. I am a trader, not a analyst. Okay, so as you can tell that the skill sets are much different. The mission that I have here for our members, before we get into the 3-day cycle presentation, simply is 4-pronged. One of the core things that I want to teach our members and help them become better decision makers, improve their decision making skills. And a lot of folks, traders, have difficulty with disempowering habits or bad habits. We want to help them learn new empowering ones in the process of being able to make good decisions. A lot of people out there that don't have a lot of experience trading think that the market is mystical. That the big firms, though they have a lot of money, kind of run things, and to many degrees they do run because of the nature of their size. But for the most part, what I try to present for our members is to demystify the market action. It's not as mysterious as you think. if you know where to look and learn from the right people. And there's a lot of good people educating out there today. And also in the last, part of the four-prong is that I don't classify people as retail or professional, all right, but rather I classify traders as informed or uninformed. And of course, the uninformed trader would be, those people that kind of come into the group with about that 95%, and those 5%, winners, right? They're usually of the informed. It does not matter how much money you trade, right? Whether you're trading a smaller account, $10, $20, $30,000 account, or a $5 million account, or et cetera, a multi-million-dollar account. All right? There are many people that I've come across over the years that trade a lot of money that they're uninformed, and I've traded dealt with folks that are traded small accounts, but they are informed. All right, so really the idea is to become an informed trader. So with that information to become a better informed trader, what I'd like to discuss today is the topic of the 3-day cycle. Now, I'm not sure how many of you have any experience with the 3-day cycle, but I'm going to give you the basics of it here, and we'll show some charts from today's action. Actually, we hit some cycle targets here today, which is kind of nice. But the 3-day cycle, also known as the Taylor trading technique, was originally back in the 1940s and 50s by George Douglas Taylor, and it was basically a short-term method to trade the markets, right? And again, I believe he traded wheat in the agriculture complex at the time, and he found that that there was a series of players that would come into the market and would essentially dominate the action. And what he found was, I'm going to start following those type of people, all right, rather than trying to figure it out where what I'm doing, but rather what they are doing. So in essence, he's basically observed what the institutional or large trader, or he simply termed the smart money. So basically, the core premise is the collection of all those smart money players, right, operators in the market at the time, right. They tend to push prices to various extremes, and in doing so, they do it in actually a repeatable cyclic pattern, right. And he discovered, anyways, from his observation, that there was a consistent repeating 3-day cycle to these patterns where prices will be pushed lower and then pushed higher, all right, and then pushed even higher to extremes and vice versa. And so he set out to measure what those extreme zones were, because he decided that his conclusion was if he could measure on a consistent basis how far institutions tend to move prices, all right, then that could give him an edge, hopefully anyways, that he could establish a position being on the correct side of that market action, being on the correct side of the institutional type flow, right, where he would be essentially trading alongside them rather than against them. So that was what his observation for it. And so the structure of the 3-day cycle, all right, is again, I refer to them as cycle day 1, 2, and 3 in my work. The original terminology was on cycle day 1, it was referred to as a buy day. And we'll go into the details of the structure of the buy, sell day, and sell short day. So sell short day is cycle day 3, sell day is cycle day 2. That can be a little confusing in terms of the terminology, but once you understand the patterns that unfold, it makes it a lot easier. So think of it as a rhythmic cyclical pattern where the markets move from extreme highs to extreme lows, all right, and so basically the general pattern, it was followed from, there was a rally from the cycle day 1 low to a cycle day 2 high, and then ultimately once it reached the cycle day 3 high, the next cycle decline essentially began down to the new cycle day 1 low. So cycle day 1 low to 3, back to 1, back to 3, in a rhythmic cyclical pattern. So that's the general makeup of it. So the core concepts and assumptions first is simply that the smart money tried to force a violation of the prior day's low, essentially creating forced selling and a panic, right? And again, this is in order for them so they can look to buy and accumulate positions, right, as low as they possibly can. So what they want to do is they want to force a sell, right, in order to buy it as low as they can. Now, years back when I was a market maker, I knew this to be true because many of the large accounts that I would be representing as a market maker, they were buyers of individual stock or futures, and what they would want to do is they would want to test the lows to see what the current lows, to see if there are other buyers there near the lows. And essentially, as a buyer of individual stock, what they tried to do is they, and again, keep in mind they're large institutions, so they can move price around and it doesn't really matter to them. They're trying to get an average price for their position, and they want to, of course, buy them as low as they can. So if they're in the buy mode, many times they'll actually sell stock down or force a sell to try to get other weak sellers, right, or to try to attract to see if there are other real sellers in the marketplace. And so a lot of times they force that a violation of the prior low, whether it's an intraday low or a previous day's low, to try to attract sellers. In other words, you have a bunch of sell stops underneath the market, right? Let's go run those stops. Let's find out if there's some real sellers because I want to buy them as cheaply as I can. And once they determine that whether or not there are real sellers or not, then they'll scoop up all that stock, right? And then they'll start buying it aggressively back up, right? We see that happen day in and day out in the markets, today. Well, that Douglas Taylor observed that, back in the 30s, 40s, 50s area, and so again, that type of technique, right, that the markets and the institutions, they continue to basically to this day. All right, so it's something that we want to be aware of, and I think most of us are aware of it, but sometimes we kind of forget what the big boys are trying to do. But of course, the folks over here at Mr TopStep really, make sure that their members are well informed on what's trying to go on. So on the opposite side, these big institutions try to force what's called a penetration of the previous day's high, and again, simply to what they're trying to do is they're trying to get the shorts to pay up so they can unload their positions that they purchased, right, at the low part of the cycle, certainly at higher levels, right? So it's the old pump and dump type of action. And once they feel as though the market has reached an extreme level, those that are employing kind of like this 3-day cycle pattern start reversing their positions and again laying out shorts at the higher levels in order for the next cycle decline. Now the cycles, as with any cycle, is not perfect, right? But there is a structure to it, and it's kind of this rhythmic fashion. So the basic assumptions of the concept is that the end of one cycle offers the greatest opportunity, all right, and the risk return is usually at its most favorable point. How I use this particular concept with our membership and traders is twofold. One, we can use this as a template for how the market is expected to unfold, all right, given if the cycle remains consistent. It offers an opportunity to position on a swing trading basis, whether it's leverage ETFs or options contracts. All right, we use that quite a bit in order to establish positions at these cycle type extremes. And then on an intraday basis, which is primarily what we do over at Polaris, is we focus on keeping in alignment, all right, in sync with this type of cycle, knowing that if it's cycle day 3 and cycle day 3 hasn't really penetrated the prior high to any significant degree, we're looking for that reversal happening and then establishing intraday shorts, hopefully at the upper edges of the range, and then work on capturing a good part of the range. So there's a couple ways of doing it, of utilizing this cycle concept, swing trading and of course intraday trading. But in both, the swing trading we usually use options contracts, which tends to obviously carry at least a set risk parameter. So you don't have to, you're not at unlimited risk with futures. When we use futures on an intraday basis, it's win, lose, or draw. All right. So basically, the excesses of each of these cycles, all right, is usually the beginning of the next, and that's usually offers the greatest opportunity. All right. So let's just go a little bit further understanding about the violation of penetration. So again, the market has a tendency to exceed prior day's highs and lows. We've seen that on a regular basis, and any residual momentum, okay, that results in that into the next day, that's called a violation or a penetration. And that residual momentum sometimes can be very strong, sometimes it can just stop and reverse, but it's really at those prior highs and lows when they do fail, offers some very, very good trade opportunities. And again, that's where the market will hit key levels of support and resistance. Now we'll show you shortly how we measure those levels. Again, we have a spreadsheet and we have some mathematical calculations that have gone back for a number of years that identify some key levels. So not only conceptually, but we have something that we work with on a practical basis, and we'll show that in a few minutes as well. So essentially, if the market closes low in its range, all right, after a significant amount of selling on a particular day, all right, the expectation then becomes that low of the day is the key reference point for the next day. Does that key low get violated? And if so, what? And it not only violated but converted to resistance, what would be then the projection of how far price could go in an extended move beyond the prior day's range? And then on the vice versa, if market closes high in its range, there's an expectation that the residual momentum is going to take prices even higher into the next day. So there has to be a way of measuring what the potential for that extension is, or if it doesn't, if we come in the next day and we look at Globex and prices didn't really, the residual momentum didn't really follow through in the overnight session into the next day's cash session. What does that mean? What does it infer? Can we make some sort of assumption, right? And then we look for a trade opportunity based act. So basically what we're looking for is whether or not the highs or lows are either rejected or accepted, right? And again, these are concepts that are given in various other techniques such as market profile and volume profiling and so forth. Acceptance and rejection, that's something that we always want to keep in mind, all right? So if price is rejected, all right, of a key reference point, again, being that high or low of the session, all right, it becomes a trade opportunity. Again, we want to align ourselves with the smart money for the next directional move. All right, so on cycle day one, we'll get a little bit more specific. The main task of cycle day one, and now again, keep in mind, it was originally called a buy day, but it's actually a day where we see in many times more selling that's occurring on that cycle day one day than there are actually buying. But the premise is, and the main task is for these big institutional folks to push price down as far as they possibly can, all right, and they're probing for a new cycle low, from which to buy up all those contracts or shares of stock, all right, for the next cycle, swing back up. All right, so it's at these key extremes, all right, that they're able to position themselves, again, via options contracts. It's usually very easy, at levels to get in on options contracts, and usually when you're thinking about it, the premiums that you end up paying when the market is going down for call options, all right, are actually contracting. So you're actually trying to get, you end up getting a good, well, at least relatively good, cost basis on a lot of these things. So the main principle was simply looking for a decline from the cycle day 3 high down to the cycle day 1, and there is an average decline, historical average decline, value that is placed upon that. And again, we have a spreadsheet that calculates what the average decline based upon a long distance of historical observations. So we're basically not guessing what the average decline is, but we do have empirical evidence, and we're comparing simply various ranges from cycle day 1 to cycle day 1 to cycle day 1. We're comparing the same cycle days, all right, over, and of course that's how you compare cycles. You're comparing cycle peaks and cycle troughs to each other. So we're simply going cycle day 1 to cycle day 1, and then we'll compare cycle day 2 to cycle day 2, et cetera, through the cycle, and we end up getting a various level of observations. All right, and then we average those out, and we get parameters that we'll work with, and we'll see that on the spreadsheet that we'll show in a few minutes. Each day I put out a daily trade strategy report. I do post a link to it in the room, in the Mr TopStep room for their members to take a look at. So in that particular strategy report, and I'll show you an example of it shortly when we get to the charts, I put out and I discuss what type of day we're on, whether it's cycle day 1, 2, or 3, what the expectation is for that particular cycle, and what are the bullish and bearish scenarios given the current activity in the market. So every day we have a trade plan, right, based upon the cycle, and again we use it as a plan. It's not a technique where we're pinpointing the entry points and exits or individual trade setups. Okay, so it acts as our core plan to begin with. And by the way, this particular trade strategy report, just to regress here for a moment, when I was a market maker at the investment banks, my particular area of expertise was biotechnology and healthcare, and I ran that group at the UBS, United Bank of Switzerland. And we would, I ran I had about 6 or 7 traders, and we would meet every morning, and each individual trader would be responsible to, making markets in individual biotechnology and healthcare stocks. And each morning we would come into our personal morning meeting, hash out what were the important events that were going on either that day or that week, and then we would condense it into a daily briefing, which was sent out to customers by 8 a.m. each morning. So what I'm effectively doing for our members is that I write the same type of report, but specifically for the S&P. All right, so let's moving on here. Basically, until the cycle day 1 low is actually in place, right, which we're expecting selling on that particular day, selling short is open. All right, so whether, again, the idea is to try to press prices as low as they possibly can and to buy them as low as they possibly can. So on a cycle day 1 type day, a normal day, all right, sometimes the cycle day 1 becomes aberrant, but on a normal day, you'll actually see more selling occurring, all right, until that low is finally reached. But once the low is reached, all right, shorts are then worked on getting covered, reversing positions to get long, et cetera, et cetera. All right, and then of course intraday we start fine tuning how we're going to do that. All right, so here's an example chart of what the cycle day 1 actually looks like. So we'll start it from the left hand side here, which is cycle day 3. All right, so number 1 here, the decline begins from cycle day 3, where the smart money effectively establishes short positions, all right, at the top of the prior cycle. And again, the top of the prior cycle is determined by effectively mathematical computations of observed past highs. Okay, so once the smart money establishes positions, again, i.e. gets out of the final longs and starts establishing short positions, they begin then to start pressing. All right, once the buyers have dried up and they have their positions, they want to start pressing their positions, right? So, and again, many of us are aware of that happening on a day-to-day basis. So they start pressing their positions, and collectively, if all works well in a perfect environment, the cycle day 3 low is then violated, right, which essentially forces all long liquidation that people that have bought on the way down, and we're not getting any recovery. So once that cycle day 3 low is violated, all right, then into cycle day 1, either the selling may continue, all right, to lower levels if the objective target lows are not met. But if they are met, then there may be a rally that does begin. But usually from cycle day 3 down to cycle day 1 follows this type of pattern, right, where the cycle day 3 low is violated into cycle day 1, and then once the projected average decline is reached, or an extreme average decline is reached, right, then again short positions from the prior day begin to get covered. And then again, these big institutions start establishing, long positions. Okay, so again, remember the market is really dynamic. It just doesn't happen in a vacuum. There's a lot of back and forth that goes on with this. But once these levels are reached, this is where we're looking for, the opportunity to establish a position. Okay, is there a level where we can start establishing positions? As a matter of fact, we're going to take a look at that today, all right, and show you how we would have used it today, all right. Now, going into cycle day 2, we'll just kind of use the same chart patterns here, right, from the cycle day 1 low. Once that low is established, okay, and all the short folks have been covered and they've established their long positions. Now what do they want to do? Now they want to start forcing the other side. They want to start forcing it, up. Okay, so once the cycle lows are established, they want to look to rally price. So this is what usually happens on cycle day 2. Now today, it's a little different. Today, it is cycle day 2 for us today. Cycle day 2 now is an aberrant day. We have weakness on cycle day 2. So the cycle somewhat is broken at the moment, meaning that the expectation would have been holding the cycle day 1 low, which was at 20.3075 today, and trying to rally. But that is not what happened. They violated the cycle day 1 low, and as such, further forced selling began. And again, you'll see that's what we wrote about this morning, and that's how the scenario ended up playing out. But normally on cycle day 2, they want to try to rally it, okay, in order to sell their long positions, right? So again, they're not always successful at that, but that is the general pattern. Okay, so again, with any cycle, we want to know what is the norm, and is the market unfolding in a normal or expected way. And if it doesn't, then we have to make adjustments accordingly. And so that's about, of course, what we all do on an active basis. Okay. And then finally, if the cycle played out in a normal fashion, near the highs of cycle day 2 high, all right, again, longs would be taken. And in this particular example, coming into cycle day 3, third part of the cycle, noticed here that the highs did not penetrate or exceed the prior highs of cycle day 2. All right, so that's what's called a failure or a rejection to expand the range higher, and as such, that sets in motion a sense of psychology that if they can't expand them higher above the cycle day 2 high, all right, then they're going to start selling them much more aggressively. Now again, keep in mind, this is an isolated cycle, all right, and what we're discussing. When you take a look at this, okay, and as it relates to Elliott wave type cycles or Hurst cycles or other type of market analysis, okay, we never want to take anything necessarily in a vacuum, but it is something that when combined with other techniques can add confirmation, right? Confluence, right? Everybody wants to find zones of confluence and so forth. So this is something that we add also. So we just use it as a framework, and it's a very effective framework as far as my position is, because again, I'm a trader. I'm not an analyst. All right, I know the other techniques, but I don't sit there and chart work all the time. All right, we all work with charts, but I'm not trying to analyze the market as an analyst would. All right, a technical analyst. I'm a trader, and as a trader, I want kind of simple, effective techniques to use. All right, and then because during the day, if I know that, hey, prices didn't exceed the cycle day two's high, all right, and I'm going to start viewing that there's a rejection there. What does that mean? Well, everybody that's long could be trapped, and I'm looking for those reversal signals that signify that those guys that perhaps are trapped are getting out. New folks that want to start shorting are getting in, and then what do I want to do with that, right? I need to be able to recognize that. So, having a framework of at least that I have found in my work and my trading over the years. Again, I learned this, technique well over 15 or so plus, 20 years ago, and I've been using it not only in my market making years ago, but even to this day. So again, it's something that I have found very effective. All right. So the final comments here, about the 3-day cycle and observations is simply that when we have a 3-day cycle, the cycle is basically from the cycle day 3 high, right, down to the cycle day 1 low, and then there's a certain range, a historical range that occurs. Okay, and again, we'll take a look at the spreadsheet, but there are very, very high odds. They're above 84% of what's called a positive 3-day cycle, even though the market sometimes experiences these bear market type corrections. The skew is for an upside market. I don't necessarily know particularly why, but I think that simply because most money managers, mutual funds are long only. All right, so I think it's important that that probably has a big factor that goes along with it. So what constitutes a positive 3-day cycle rally? All right, so if on cycle day 2 price closes on the highs, the expectation, as we spoke earlier, would be either a test of those highs, all right, and a failure or an acceptance of those highs. All right, and if the highs are tested and prices cannot get through the cycle day 2 highs, all right, then that was referred to as a rejection, and then again the sell would ensue. All right, if price closes low on cycle day 2, again everything's kind of based upon cycle day 2, right, and that low is still above the cycle day 1 low at the beginning of the 3rd day cycle, it's a positive 3-day cycle. All right, it's just more of some technical aspects. So today we're currently in a negative cycle. All right, since today is below the cycle day 1 low, so it's going to be key for tomorrow to get back above that cycle day 1 low sometime during the day to notch a 3-day cycle, positive 3-day cycle rally. All right, so from my vantage point, having traded 20 some odd years as a market maker, I've worked one-on-one with many big institutional accounts throughout those years. I've learned the 3-day cycle pattern from large mutual fund type traders, all right, that they utilize it, and I've learned it from, I've discussed this with more than one, all right, over the years. So, these guys collectively, they're using a lot of different techniques, but, the overall collective action seems to be that, that they want to force those lows, they want to force those highs, they want to try to, From my perspective, one thing that I've learned anyways is that the market tries to satisfy the ranges. I'm a big average true range type trader. I need to know what the 10-day average true range is, what the monthly ranges are, and usually, how the market gets to these levels, whether it's in an Elliott wave 5 pattern, ABC 1 2 3 type patterns, or any other way it gets there, is how it gets there. But the fact that the market tends to want to satisfy ranges is something that I've observed over the years, and I need to know, part of what we do on a daily basis, I need to know what those ranges are. All right, so it's really important. On our website, we have a section called the average to daily average range calculator, and that calculates the average range automatically for everybody. So that's free, and I'll show that in a minute. That's free for everybody to explore. All right. So what we've done in this particular cycle, now we've gone from, this is the cycle concepts that we're talking about, and now we've made a practical ebook to work with, a spreadsheet. So I've worked with this other gentleman by the name of Rich Boisvet, and he has actually created a ebook spreadsheet that calculates all these observations. Now remember, Douglas Taylor back in the day, right, in the late 40s, he did all these things by hand, and he called it the book method. And so, today, with the onset of the computers and everything else, I mean, it would be insane to do all these observations by the book, by an actual physical book. So what Rich has done is created effectively an electronic book, making the same type of observations directly from, and these calculations, by the way, that we're using today are based upon the exact same concepts and how Douglas Taylor back in the day did his calculations. So now we're doing it electronically, and we generate a spreadsheet daily for our subscribers and our members. And so we'll take a look at in just a moment. So and then we'll take a look at a few charts for it today. All right, so basically once we have these levels in mind, we then will plot them on our charts, because we have an indicator that will plot for us. And again, this gives us that template. Here is a look of the spreadsheet, all right, what it looks like, and I'll show you, this was back from March 21st, but we're going to show you a live one from today in a moment. All right, so let's just move over to the charts, and we got about 15 or so minutes left. And here is, everybody should see two charts up there. On the left-hand side is the 60-minute E-mini S&P, and on the right-hand side is the crude oil chart, 60-minute. So what we have here is based upon, well, actually, before we get there, let me just show you the spreadsheet for today. All right, this is a spreadsheet for today. Again, this is produced after hours every day. It's delivered to our members and our subscribers at about 5 p.m. Eastern Time. And I won't get into the details of all the numbers here, but because that is a subject for actually a full webinar in and of itself, which we've done with our members. But basically what it shows is, it shows what the possible high or the possible low is for cycle day, or a particular cycle day. So today is cycle day 2, based upon whether there's a penetration or a violation of the high or low of the prior day. And based upon that, we have statistical ranges of where prices could go. Okay, so for instance, I believe the low is still holding today at 22s. Am I correct with that? If you take a look here on line 9, in the cash session, all right, the possible low for cycle day 2, based upon an average violation of cycle day 1 low. Okay, thank you. So it is 22 is still the low. So based upon the violation of cycle day 1 low on cycle day 2, which is today, all right, the projected low based upon historical ranges, observations, is 2021 spot 90. So rounded that to 22. So the low projection for the day, right now is effectively hit to the tick. All right, and there was a 65% chance of that occurring if the low of cycle day 1, yesterday's low, all right, was violated. All right, I have found that these calculations, by the way, are not anomalies. I have enough historical experience with these. Now, again, you can take my word for it or not, but there's enough evidence that I've certainly amassed personally that these numbers are not anomalies at all. And again, I use these very, very effectively. So what we look to do is, like for instance today, where the market broke down, it broke through the 30.75 cycle day 1 low. So what I wrote on our daily trade strategy, and let's bring that up so I show you guys, what it actually looks like. Okay, so this is mailed out to our members every day, and then it's posted to our website on the blog section. So under the blog, you'll see PTG Daily Trade Strategy. All right, and again, today's trade strategy is all right. So what I wrote here today is cycle day 2. All right, bulls are on the edge again, and a violation and conversion, all right, of the 2028s could force some liquidation. 28 to the 30 zone, all right, could force some long liquidation. Of course, I think that's what happened today, right? Now, below that, I have 2 scenarios. And scenario 1 is the bullish scenario, and of course, scenario 2 here is the bearish. So let's just focus on the scenario 2. So scenario 2 simply said, violation and conversion of the cycle day 1 low, again yesterday, increases odds of continued selling, initially targeting 27.25, followed down with a range between 23.25 and 18.5 extreme lows. All right, so that's the zone or the target zone. All right, and what we do here is, along with this, I present the chart for our members. I like to be visual. All right, so I present the chart for our members as part of the daily trade strategy, and I think I can blow this up a little bit so you can see it. Is we have the high and low day of range projections, all right, based upon the 10-day average to range, all right, as well as cycle day maximums, violation levels, and so forth. So as you can see here, we labeled the cycle day 1 low at 20.30.75. Now again, the daily trade strategy that I wrote, and the whole idea about the cycle from cycle day 1 to cycle day 2, all right, would be if price was able to hold the cycle day 1 low, then there could be a rally that could have unfolded today. That would have been the norm. All right, today, according to the cycle, it's an aberrant day. All right, it didn't fit the normal pattern. All right, so as a result, a violation of that low. Now, keep in mind, I don't know what's going to happen during the day, nor does anybody for the most part, but we set up scenarios that if this happens, we make an inference that if this event happens, then the probabilities favor, upside. If the scenario 2, which is the bearish scenario, if that begins to unfold, well, then the scenario and the probabilities favor downside. Now, okay, that's great to say, but now what we take it a step further is how much downside potential does the market have? And this is where the historical observations of the spreadsheet come into clear view. All right. So today it was a break of the cycle day 1 low, again, which is aberrant for today, and having that happen, the market's potential to the downside. So we would then begin to establish short positions early in the morning. All right, and then either hold them or again trade them throughout the day. All right, until we reach some key levels. All right, so the lower day range projection, the average to range projection was 23.25, and then the maximum low based upon cycle day 2 observations historically would push it down to 2089.69. Okay, so that was the chart that we send out to our members each day in this particular report. All right, so now let's go beyond the report and drill down into the actual today's action. Okay, so again, here's the spreadsheet. It gives us all the figures critical, all right, in advance. Again, this is mailed out the evening before, so everybody is well prepared for the next day. And then drilling down into our charts now, again, I'm just showing this on a 60-minute chart. As you can see here, cycle day 1 low is in red. All right, and of course the violation of that cycle day 1 low here, all right, forces that violation and that forced selling that we were talking about. Now we have a zone in here, all right, based upon the cycle days historical observations and calculations. All right, so these would be the targets based upon what we've seen over 20 cycles. Now 20 cycles, each cycle is 3 days. So we got 2 months worth of data, and these cycle also observations go back 8 years since when it was when we first began this. But the past 20 cycles works very well, and as you can see here, 2190 was an average violation. That's why it's called the MAV. So this is an average violation of the cycle day 1 low. The projection then was initially to 22. Now, if the 22s at some point today fail to hold on a retest, okay, we have lower projections between 2050 down to 1850 as max extremes. All right, so right now the cycle objective has been met. All right, and this is how we use this now. Again, remember, this offers a framework. All right, this isn't a technique that, you know, oh, I know what's going to happen. But what we do is using it as a game plan each day, so we know, since we don't know what is going to happen, we know that if certain events occur, all right, then there's more likely an opportunity, you know, to take a trade in that direction. And then that's when we hone it, we fine-tune things on the intraday charts, execution type charts that we use, and then we go to our specific setups that we use, which is not subject of this presentation today, but rather to show you how the cycles do play out. Now, again, this is not a one-off. All right. I've just used this so many years that it works very, very well. Take a look, for instance, all right, at crude oil here on the left-hand side. So you'll see, all right, this is cycle day 2, by the way. All right, and let me just put a marker here. This was the cycle day, let's see, this was the cycle day 1, let's see, we're in 519, right? Okay, so this was actually the cycle day 1 high here, all right? And so as you can see here, what happened on the push-up, all right, the prior high was not, they were not able to exceed the prior high. So as a result, once they violated that low, this low right here, okay, the selling began to accelerate, okay? Then once they violated the cycle day 1 low, all right, the projection was the MA, which is the average violation target, all right, at 47.52. So once the cycle day 1 low was violated, similar to what happened here on S&P, all right, they pushed price down to these average violation level. And notice what happens, right? again, the selling got absorbed in a very, choppy fashion nonetheless. All right, and then they reversed it off of that cycle day one low. So in conclusion, how would we use these type of cycles in the events that occur during here, right? Whether it's the S&P, whether it's crude oil, we can establish, if you're a swing trader, we can establish swing positions via ETFs, right? Leveraged ETFs, or if you're using it for your IRA, again, there's a lot of different ways to do this, or use options. Okay, I prefer to use weekly options, right, or the monthly options to establish, various positions. All right, and again, you can do the same thing, and a lot of folks do that. Instead of buying futures contracts in oil, I'm going to buy, a crude oil call. Okay, and when you're buying them on the weakness, you're actually buying them, all right, with hopefully good premium or discounted type premium on that call. All right, and you establish risk, and boom, work its way back up. All right, so this is how we use the 3-day cycle, folks. And again, if we have a subscription to this, and you can visit us on the website if you wish. And again, you can reach me for additional information at david@polarisTradingGroup.com, or visit us at I think there's a website up there. There you go. Thank you very much, John. Posted it, PolarisTradingGroup.com. Okay, so thank you very much for your attention. If there's any questions, I got about a minute or two remaining. Sorry that we don't have too much time left, but I'll be happy to field any questions anybody may have here, or if you want to talk one-on-one. All right, I'll be happy to field those questions as well, via telephone or via email. Okay, I think I've reached just about my limit for the hour. We're going to have another great presentation coming up. Okay, you can use it on a weekly or monthly chart. Yes, absolutely. All right, the chart type itself is just random. All right, all depends what you decide to want to use. I usually use it on a 60-minute chart, but if you wanted to use it on a larger time frame, dailies, weeklies, you can. But primarily, keep in mind the 3-day cycle was originally designed for a short-term trading technique, 3 days. So I think it best works on that shorter time frame. All right. Thank you very much for everybody for your attention. Again, I want to thank you, Danny Riley and the folks over at Mr TopStep, for my inaugural presentation with you folks, and you guys have been great. Thank you very much, and enjoy trading, and enjoy the rest of your boot camp. I appreciate it. Thanks very much, everybody.